Welcome to my channel. Please like, comment, and subscribe. Regional and country grouping contribution to maritime trade and maritime trade underperform across market segments. Regional and country grouping contribution to maritime trade in 2019. Developing economies continue to account for the lion's share of goods being loaded, 58%, and unloaded 65% in seaports worldwide. Together, developed economies and economies in transition generated 42% of global merchandise export by sea, goods loaded, and imported 35%, goods unloaded of such global trade. While the role of developing regions as a source and destination for maritime trade is significant, developing economies are not a homogeneous group. The group includes countries and economies in varying stages of development and degrees of integration in the world's manufacturing and trading networks. Much of the growth recorded over the past decades is largely driven by fast-growing emerging developing countries, most notably China. These countries have also been driving the structural shift in trade patterns observed since 2013, whereby volumes unloaded in developing countries exceeded volumes loaded. The shift is a reversal of a historical pattern where developing countries act as suppliers of large volume, low-value raw materials imported by developed countries. There is a predominance of ASEAN and intra-ASEAN trade in globalized production processes and value chain growth. A closer look at this trend indicates that the globalization of manufacturing processes has never been truly global. There is scope for other developing regions within and outside Asia to diversify their economies, expand their maritime transport capacity, and participate more effectively in regional and international production processes. The marginal contribution of these economies to global value chain is reflected in the relatively limited contribution to container trade flows and global container port throughput. Maritime transport, combined with supportive trade and industrial policies, can be a catalyst for growth and greater integration in the world economy for a broader range of such developing countries. In 2019, 41% of the total goods loaded exported were sourced from Asia and 62% of total goods unloaded imported were received in the same region. The contribution of developing America and Africa to maritime trade flows remained marginal. In comparison, and as previously noted, Asia has benefited from a greater integration into global manufacturing and trading networks, promoting intra-regional trade. Capitalizing on the fragmentation of globalized production processes, Asia has become a maritime hub that brings together over 50% of global maritime trade volumes. Maritime trips underperform across market segment. Dry cargo continued to account for over two-thirds of total maritime trade volumes, while liquid bulk commodities, including crude oil, refined petroleum products, gas, and semi-coal, accounted for the remaining share. In 2019, growth in all market segments decelerated. Trade in dry cargo expanded at 1.1% over 2018, and tanker trade volume contracted by 1%. A look at how the various market segments have evolved since 1990 shows that growth in maritime trade over the past 3 decades has been sustained by bullish trend in containerized trade volume starting in 2000, coinciding with the wave of hyperglobalization. It was also supported by the swift growth of trade in dry bulk commodities that accompanied the rapid industrial and expansion of China that accelerated with its accession to the World Trade Organization or WTO in 2001. When adjusted for distance travel, international maritime trade grew at a slightly faster rate of 1% in 2019, supported by growing long-haul oil export from Brazil and the United States to Asia. Clarkson Research estimates seaborne trade in ton-miles to have reached 59,503 billion ton-miles in 2019. Trade in container and dry bulk commodities has fueled much of the growth over the past 2 decades. The number of cargo ton-miles generated by dry cargo has been rising steadily over the years. In 2002, China imported 121.7 million tons of iron ore and coal, accounting for 11.8% of the global iron ore and coal trade by sea. In less than 2 decades, these volumes increased to 1.3 billion tons, bringing the country's market share to nearly 50% of the world total. Gas trade in ton miles expanded swiftly to 9.9% in 2019. Other segments recorded relatively smaller growth. Ton miles generated by trade in chemical expanded by 3.2%, followed by container trade 1.9% and other dry cargo 1.6%. Growth in ton miles production by trade in oil and measurable commodities contracted in 2019, reflecting declines in iron ore trade following the disruption to mining activities in Brazil caused by the Bell and collapse. Demand and supply side pressures weighed on key market segment. Trade in oil weakened, while trade in gas remained robust since the onset of the shale revolution in the United States. Development in the country's energy sector have played a significant role in shaping global tanker trade. This was apparent toward 2019 with a decline in the United States crude oil imports and a rise in its long-haul export. Crude oil trend decreased by 1.1% in 2019. Downside factors include the cuts in supply by members of the Organization of the Petroleum Exporting Countries (IMF) supporting oil prices, as well as disruption affecting export from the Islamic Republic of Iran and the Bolivarian Republic of Venezuela. The impact on export from Western Asia resulting from the attacks on Saudi oil infrastructure was limited. Pressure on the demand side include lower global oil demand, a sharp reduction in United States imports, and a decline in global refinery activity. However, expansion in export from Brazil and the United States have supported long-haul journeys from the Atlantic to Asia. Crude oil import to China increased by 10.6% in 2019 compared with the previous year, while imports to the United States declined. In Asia, extended refinery maintenance and smaller refining margins contributed to limiting import growth. Other tanker trade experienced difficulty in 2019, contracting by nearly 1%. Major setbacks included slower global economic growth and extended refinery maintenance periods, with many refiners adjusting production in preparation for the coming into force on 1 January 2020 of the IMO 2020 regulation on a sulfur cap for marine fuels. In addition, naphtha faced competition from liquefied petroleum gas as a petrochemical feedstock. Arbitrage opportunities were limited, and new oil trade declined. The latter accounts for over 20% of trade in seaborne refined petroleum products. Thanks for watching. Don't forget to like, comment, and subscribe.